They're running out of money. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Walmart's shocking announcement warns of grave danger to the U.S. economy. And I will show you what the big retailer is warning about and why it means the U.S. labor market is in danger as consumers all over the country are running out of money. Plus, we have a sponsor for today's show. I'd like to welcome Critical Metals back to the show. You can find them on the NASDAQ under the symbol CRML. And the reason you want to check them out is earlier this week, we featured a company on the show. And this morning, their stock jumped by 88%. And we think Critical Metals is next as their stock is on the cusp of a technical breakout based on the news that they just signed a huge contract with BMW. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to CNBC, where we picked today's story up with a headline of Walmart rolls out new training programs for skilled trades as it tries to fill high demand roles. And on the front of the headline, it would seem that the U.S. economy is booming and it's not creating enough skilled workers to fill all of these roles. But the real underlying issue that Walmart is facing is a pay. And this is all about the fact that their own employees, and we're seeing this happen all around the country, cannot keep up with inflation, and Walmart's trying to make it look good. As on Wednesday, it said it will offer new training programs and certifications to fill high demand roles across its business, such as HVAC technicians, opticians, and software engineers. The big box retailer also said it will offer another reason for hourly store workers to stick around, a bonus of up to $1,000 a year. And really the underlying issue here is Walmart's own employees are not keeping pace with the economy. And this is a huge challenge because as we look at the data, we still see that inflation is running faster than wage increases, which means employees and consumers all around the country are running out of money. And the company says its average hourly wage is nearly $18, up by about 30% over the past 5 years, with a starting pay in stores ranging from $14 to $19, depending on the location. And even though they reported $648 billion in total revenue last year, the median employee compensation was only $27,642. The problem is this falls below the poverty line of $31,200 for a family of four, suggesting that Walmart can't even pay its own employees enough money to stay out of poverty. And this is just an issue we're seeing all around the country as companies like Walmart, McDonald's, Burger King, and even Target are saying that consumers are running out of money. They can't afford discretionary items and are focused on cutting their budgets every way possible on all the things they need to have. And what we're seeing at employers, and Walmart being one of them, they just aren't paying people enough. And Walmart's new programs give employees more ways to move into higher paying jobs, which is great news as the company is piloting a 6-month training program in the Dallas-Fort Worth area. And those skilled jobs will pay between $19 and $45 an hour. Now, the initiative was inspired by a similar program for another high demand role, truck drivers, as the Associates of Driver program produced more than 500 new drivers since launching in the spring of 2022. And this would give you again the impression that the economy is booming and there just aren't enough skilled workers for all of the skilled jobs. But the reality of the issue is we talked about this in the show yesterday of why President Joe Biden is looking to cut immigration. It's everything to do now with people coming into the country, taking away these jobs from American workers. And now we need to boost their skill set up, because when we look at this chart, we're seeing that Walmart is just not paying their employees enough. If we look at average hourly earnings of production and non-supervisory employees versus the consumer price index, that's shown in red, both on a year-over-year rate of change. And the issue here is consumer prices remain sticky, yet wage growth is slowing in a big way. Of course, we'll have the official data on this tomorrow from the government, but what it suggests is something we've known for a while, that employees are not keeping pace with inflation because they're not getting the hours. They're running out of money, and this is a huge problem for the economy because when spending goes, well, jobs are going next. And one thing we think is going to go in a big way, that's the stock of our sponsor of today's show of Critical Metals. Check them out on the NASDAQ under the symbol CRML. Let me give you a preview. You can see the MACD and the relative strengthened index rising as momentum pushes higher, the stock moving with it. You see this red line, that's the 6-month volume profile. This is where all the shares have been traded over the last 6 months, at least the most of them. You break out over the supply zone and sky is the limit, because one thing Wall Street is now coming to reality with is the biggest economic shocker of all. The jobs in the past year, most of them have gone to illegal aliens, and now it starts to make sense why President Joe Biden is stepping in, trying to curb immigration, as we mentioned in yesterday's show, because he's realizing these people are taking away these low-wage jobs from Americans, and they just don't have the skill set to move into higher-wage jobs. Walmart at least taking the first step. My problem is it's too little, too late. And for much of the past year, we have been pounding on the table for two very simple facts. Just from Zero Hedge, not only has the U.S. labor market been appallingly weak when most of the jobs gained in 2023 and meant to signal how strong the Biden recovery has been, they're about to be revised away, as the Philly Fed and Bloomberg have both admitted. But the problem is a lot of the job growth over the past few years has not gone to Americans, this being a big issue, because when the labor market goes, we know who's going to lose those jobs first. It's of course Americans, and the higher wage jobs are gone. As echoing what we have said for months, Englander writes that immigration, particularly illegal immigration, is political flashpoint, has become an important factor in assessing economic performance. Detailed data from U.S. Customs and Border Protection and U.S. Citizenship and Immigration Services suggests, get this, half of non-farm payroll growth to date for this year, looking back from August 1st, have been from undocumented immigrants who have received an employment authorization document. And the non-farm payroll report counts workers with an EAD just like any other. And using that data, it's easy to estimate undocumented workers have added 109,000 jobs per month to non-farm payroll, out of the average 231,000 increase in the fiscal year for this year. So we already know that U.S. workers are not keeping up with inflation. The data says they're running out of money, and now they're having to compete with immigrated workers. This is dangerous because, of course, we know they will take low-paying jobs, squeeze American workers out. And in any event, Englander estimates that over 800,000 undocumented immigrants have found jobs in fiscal year 23, and that assumes that 64.2% of EAD recipients are working. But get this, however, the employment rate may be well higher since these are likely very motivated workers. Using this calculation, the non-farm payroll report grew at 3.1 million in fiscal year last year. The 800,000 would represent more than 25% of the growth in the economy. And again, this is dangerous for U.S. workers who need to get their skill level up to take those jobs. But the problem is they're competing with people coming into this country who work at any wage because they need the jobs. This is putting downward pressure on, of course, average hourly earnings. And when that happens, well, it means the labor market's about to go. As initial jobless claims now rise on 8-month highs, and here we see, according to the Bureau of Labor Statistics, 229,000 Americans filed for jobless benefits for the first time last week. But that isn't the issue here. We know that number is going up. And if we look at, of course, the weekly continued claims data sitting right around 1.8 million. And this is something I have flagged as a huge problem. This number is not going down. So what it means is when people get on unemployment, they're unable to find a job. And those that are able to, well, there's enough new people that are getting stuck on unemployment to offset that. And the longer they stay on unemployment, the more their spending power goes down. And that is an issue which Walmart has flagged. Of course, they know discretionary spending has all but dropped off as everyone focuses on the staples. And from an economic perspective, well, it means more layoffs are coming, because we look at these average hourly earnings of production and non-supervisory employees. And I want you to be thinking about all these people coming to the country, competing for low-wage jobs or adding to the workforce. But look at this data. It's shocking as we see as average hourly earnings decelerates, shown in blue. What do you know? The continued unemployment claims rise. So it makes perfect sense why President Joe Biden needs needed to put an end to this because he knows that the robust U.S. labor market that everybody's saying is strong and driving the U.S. economy is not robust at all. In fact, it's about to come apart in a major way because we can note that there is a big deceleration in average hourly earnings. And as I mentioned earlier, we'll get an update on that tomorrow. But the problem here is continued claims are eating away at that. There is an ample workforce looking for a job and people coming into this country competing with them. It's driving wages down even more. And when you have people on continued unemployment claims for extended period of times, well, they lose their purchasing power because obviously unemployment doesn't pay as much. So they have to eventually start cutting their spending as they know that rents and food and energy prices are going up, not to mention their debt payments. And what that means is they spend less in the real economy because they have less. Well, other jobs go, and we can see that where continued unemployment claims go, eventually initial claims will follow, and initial claims have remained historically low. But the issue is not for much longer. Even Walmart's trying to keep people on the books, but that's not going to be successful as first quarter U.S. labor costs have now marked down on weaker output and hours. And that's a key thing here is we're seeing employers cut hours. And now it is in the official data that we're seeing demand fall so much that employers have no choice. Eventually you cut hours and not, you cut jobs. As unit labor costs are what a business pays employees to produce one unit of output after taking into account changes in productivity, rose at a revised 4% annual rate, down from initially reported 4.7%. And that has everything to do with inflation. In fact, this is the biggest issue right now. We talk about what the Fed wanted to do. They wanted to bring inflation down. They actually did want to bring wages down, which is staggering. And this is very difficult to understand why they want people to make less in the face of high inflation, but this is what they wanted, and this leads to, of course, more people on unemployment. But everyone says that inflation is only going to go higher. This data suggests otherwise, because when we look at unit labor costs for employees against the consumer price index, that's shown in red on a year-over-year rate of change, you can see unit labor costs are plummeting against inflation. And when we've seen that in the past, it means we're headed into a recession, if not in one already in the early phases, and that inflation is indeed about to come down in a major way. You only get inflation when unit labor costs are running at the same pace or exceeding inflation. And while the Federal Reserve would like to see lower unit labor costs, they ideally would like to see through greater productivity, which can be the result of efficiency gains or technological enhancements. And what that really means is they don't mind people going on unemployment as long as there's demand there and that other workers that are still keeping their job are able to produce more, have a higher output per hour. And that is what productivity is. The problem is it's going the wrong way. And we see that labor costs rose at a slower pace in the first estimate as workers turned out less output. But real or inflation adjusted hourly compensation, that went down too. And productivity, or the output per hour of non-farm employees, barely rose in the first 3 months of the year, revised down slightly to a 0.2% pace. On the whole, quarterly productivity figures are volatile, and that said, a sustained slowdown would represent another hurdle for the Fed's quest to tame inflation, because the real issue here is the Fed wanted to crush demand. The actual thing they did was crush demand, and then they did it in a big way, because what we're seeing is a unit labor cost drop, productivity stall, which means that those who still have their jobs, they just don't have enough work, and that is the problem. The Fed's going to send us into a recession, and what the Fed wanted to see was labor productivity rise, which would send consumer prices down. And what we're noting here, there are periods where labor productivity declines, and what you see is consumer price index rises. Right now, what you're seeing is the problem of what the Fed really wanted was productivity to go up. The problem is inflation isn't coming down fast enough. It's soon going to fall. But the real issue here is there just isn't enough work for employees. That is not what the Fed wanted. They actually wanted the economy to boom and those who kept their jobs to be more efficient at it, and then other people to get on unemployment and then have new jobs created for them. It didn't work out. We know that we're headed into a recession for sure now, as productivity reports showed output rose at 0.9% pace in the first quarter, the smallest advance since 2022, and real hourly compensation just climbed 0.4% compared to initially reported 1.1%. As hours worked rose about half of the reported pace, meaning people are not getting enough work. The Fed did crush demand. The problem is they crushed it in the worst possible way, which is something they always do. As we look at real hourly compensation shown in blue against the consumer price index in red, and if you're looking for inflation, well, you're not going to find it, because when real compensation stays near that zero line as shown by, of course, the horizontal black line, what that means is inflation eventually does come down. We can see that effect as real compensation drops and then inflation rises. Eventually, inflation comes rocketing down. That is the expectation now going forward, as consumers, as we're seeing, and the data continues to validate, they're running out of money, which means the Fed's about to do something the ECB just did, as they delivered a landmark rate cut with no signals on the next step. Don't worry, the next step will be another cut. And why will the Fed do that? Well, it's very simple. If you look at unit labor costs in blue against the federal funds rate, what you can know is unit labor costs are plummeting. And normally the Fed should be cutting rates at this time. This time they're not, because they think inflation's a problem. When inflation falls to the floor, the Fed is going to aggressively cut, because they're going to find themselves on the wrong side of the curve. But one thing we think is on the right side of the curve, that is the stock for our sponsor today, Critical Metals. You can find them on the NASDAQ under the symbol CRML, and they are securing metals for Europe's switch to clean energy, and they just had a huge contract with BMW as they received a prepayment for the Wolfsburg lithium product in the amount of $15 million. And here we can see they're a leading mining development company focused on critical metals and minerals for the green energy transition. And they announced that BMW has transferred funds of $15 million to ECM Lithium, a wholly owned subsidiary. This payment is in relation to the offtake of battery-grade lithium hydroxide from the Wolfsburg's lithium project in Austria, which is to be offset against lithium hydroxide delivered to BMW. And we're pleased to move our partnership with BMW forward and look forward to supporting the production of their electric vehicles in Europe in the years to come. This from CEO and Executive Chairman Tony Sage, as they look forward to contribute to more sustainable and domestic battery supply chain. This prepayment further strengthens our balance sheet and will allow us to further advance the development of our strategy, and I think that is going to be the catalyst to send their stock higher. Again, you can find them on the NASDAQ on the symbol CRML, and we've seen here, we've drawn in the supply though, and this is where the sellers have been dominating. But right now, based on the back of this news, I'm going to show you where the buyers are at, and they're looking to push through here. A breakout above the supply zone of approximately $12 could send the stock rocketing higher, as there's no sellers sitting above that. Here's we zoom into the 30-day chart, you note the volume profile. This is where most shares have been traded over the last 30 days. You see buyers aggressively coming into the stock. They know about that contract with BMW. They're excited about it. They know this means there's going to be a lot of future business for critical metals, and they believe that's going to be very bullish for the stock. And we zoom into the 10-day window here, and you can see the setup. Buyers coming in at every opportunity here, looking to take critical metals higher, and we think that could be a big winner for your brokerage account. Again, check them out on the NASDAQ on the symbol CRML. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.